Operational cash flow is the lifeblood of your business. So let's talk about the mathematics of calculating operational cash flow. The operational cash flow calculation brings together the most important components of your operational income statement with the most important components of your operational balance sheet. It is also a very similar calculation to that being done by your banker to assess the cash flow health of your business. On the first line, revenue for the 12-month period is then adjusted by the movement in accounts receivable to calculate how much money has come in to the bank account. In this instance, $15.561 million was invoiced for the year, but because the accounts receivable balance increased by $589,000, the amount of money that the business collected was only $14,971,000. The other $589,000 is still sitting in your customer's bank account. The direct costs are then adjusted by movement in inventory and movement in accounts payable. In this instance, the inventory balance has increased by $208,000, so that puts an additional burden on the cash going out of the business. Although in this situation, accounts payable has also increased by $384,000, and that has taken some of the pressure off cash flow. So while the direct costs are $11.72 million, the amount of direct cash that actually exited the bank account was $11.544 million. $14.971 million comes in, $11.544 goes out, giving us a cash contribution margin of $3.427 million. From that, we deduct our indirect costs, not including depreciation, and we adjust by the net miscellaneous revenue expense and the cash generated or cash used for miscellaneous operating balance sheet movements. And that brings us to our operational cash flow that can be expressed in dollars, in this instance $635,478, or as a percentage of revenue. And as a percentage of revenue, it is telling us how many cents of cash we are generating for each dollar of revenue. The other thing that I would challenge you to watch closely in the top part of the dashboard is the percentage increase changes of core revenue, direct costs and indirect costs. Particularly the comparison between core revenue and direct costs helps us to understand whether our margins are improving or deteriorating. If our revenue has increased by a larger percentage than direct costs, as it has in this example, revenue has increased by 13.34%, direct costs by 12.47%, the margins in this business have improved. Compare the change of indirect costs to the change of revenue. In this instance, while our business is 13.34% bigger, our indirect costs have increased by 22.27%, which should generate a robust conversation as to why the business spent so much more money on indirect costs, and was that spending investing for future in strategic investments that we refer to as J-curves. The operational cash flow calculation is designed to be easy to understand, but more importantly, it is designed to drive a critical conversation amongst your leadership team. If you do not like the amount of operational cash flow that you've generated, do something about your revenue, your accounts receivable management, your direct cost, your inventory management, your accounts payable management, or your indirect cost management. All of those things are within the responsibility of your leadership team. This report should create a robust leadership conversation that highlights where you are managing the business well and where you can improve. And most importantly, ensuring that you generate more value tomorrow than you generated yesterday.